Something is quietly breaking in America, and the unsettling part isn't what it is. It's that most people can feel it, but can't find the words for it. It's not a crash, not a collapse. No single moment anyone can point to. It's showing up in smaller places than that. In the grocery store parking lot that used to be packed on Sunday afternoons, now half empty. In the checkout line, where a woman quietly puts 3 items back before the cashier finishes scanning. In the break room at work, where a co-worker mentions, offhand, that they've started bringing lunch every day because stopping somewhere on the way in just doesn't make sense anymore. None of that makes the news, but here's what's striking. Millions of people across this country are having that exact same moment in different stores, different cities, different break rooms, and most of them think they're the only one. They're not. Today, we're connecting those dots. Groceries, insurance, housing, jobs, credit cards, every piece, one clear picture of what's actually happening. Because individually these look like inconveniences, together they tell a very different story. Let's start where almost everyone first notices it, the grocery store. You walk in with a rough number in your head. You buy what you always buy. Same brands, same cart, same routine. You reach the checkout, and the total is just a little higher than it should be. Not dramatically, just enough to notice. You pay, you move on. And then it happens again, the next week and the week after that. Now here's the part most people don't catch. It's not always that the price went up. Sometimes the price is identical, but the bag is lighter, the container is smaller, the package looks exactly the same, there's just less inside. 11 hours of coffee where 14 used to be. Fewer crackers in the same sized box. A yogurt container that looks full until you compare it to one from 2 years ago. This is called shrinkflation. Companies do it deliberately because people react much more strongly to a price they can see change than to a quantity reduction they'd have to actually measure to notice. Most people don't weigh their cereal. So the product shrinks, the cost per unit rises, and the consumer absorbs it without ever having a clear moment of realizing what happened. But shrinkflation is only the surface. The deeper signal is in how people are behaving inside those stores. And this is where things get revealing. Watch the next time you're at the grocery store. Really pay attention. You'll see people checking for the store brand version before anything goes in the cart. People cross-referencing prices on their phone before committing to an item. People buying 6 of something they only need 1 of right now because it's on sale, and they no longer trust that price will hold next month. That last habit is worth thinking about. Stocking up on deals used to be something couponers did. Now it's mainstream behavior. Not because people are worried the shelves will empty, because they've quietly stopped. Prices will be stable. That is not the behavior of a population that feels economically secure. That's a population in a quiet, ongoing defensive crouch, and it's showing up in how they eat, spend, and move through their daily routines. Fast food tells the same story, just louder. For decades, fast food was the fallback that required no thought. Affordable, fast, predictable. That relationship has changed. People now open apps before they even decide what they want. Not to browse the menu, but to find a discount that makes the purchase feel justifiable. Value meals have been repriced to where they require an actual decision. A family meal at a fast food counter, the cheapest option for most Americans for a generation, is now something people genuinely weigh against alternatives. Even the daily coffee run, a habit millions never thought twice about, people are reconsidering it. Not because they don't want the coffee, but when you add up every small daily spend, it's no longer a small amount. Here's the thing though. One person skipping a coffee means nothing. One family using a coupon means nothing. But when tens of millions of households are all making those same quiet substitutions simultaneously, that's not personal choices anymore. That's a signal. And it's pointing towards something much bigger than grocery prices. Because the pressure driving all of this, it didn't stay where people first noticed it. For the first 2 years after the pandemic, inflation was easy to see. Gas, groceries, used cars, all visible, immediate, covered constantly. Then the headlines changed. The consumer price index came down. Economists said the worst was behind us. Here's what they didn't fully explain. The pressure didn't disappear. It relocated. A nurse in Tennessee opened her mail one evening to find her homeowner's insurance renewal. Same house, 6 years, no claims, her premium was up 31%. She called. The agent explained politely, Regional rate increases, higher rebuild costs, updated risk models. Nothing to dispute. She adjusted her budget and moved on. That same week, a retired couple across town quietly reset their thermostat from 74 degrees to 78 degrees. Not because they'd gotten used to the heat. Their electricity bill had been creeping up every year. They were managing it 1 degree at a time. 2 households, 2 small adjustments, no coverage anywhere. But here's what connects them, and why it matters more than the grocery examples. Both represent a completely different kind of inflation than the kind making headlines in 2021. And the second kind has no real workaround. When the price of eggs goes up, you have options. Buy fewer, try a different protein, switch brands. The pressure is real, but so is your ability to respond. When your car insurance goes up, you don't have that flexibility. You can call other companies, but when the entire industry is raising rates simultaneously, driven by higher repair costs, rising medical costs from accidents, more severe weather reshaping risk models, there's no version where you opt out. You need insurance, full stop. Same with electricity, property taxes, medical bills. There's no store brand version of your power bill, no coupon for your insurance renewal. You pay it or you don't, and not paying has its own consequences. This is what economists call the shift from goods inflation to services inflation. Goods inflation is painful, but you can adapt. Services inflation follows you home. It's in your mailbox. It's in your banking app at midnight. And there is almost nothing you can buy your way around. A plumber in Georgia put it simply. A few years ago, customers called with a problem and wanted to know when he could fix it. Now about half his calls open differently. They want to know how bad something actually has to get before it needs to be dealt with right now. Not because they don't understand plumbing, because they're calculating how long they can wait before spending money they don't currently have. That's the signature of this second wave, not panic. Prolonged delay, and delay compounds. The $300 fix in spring becomes a $2,000 repair by fall. But $300 is exactly what people don't have right now. So they wait, and the problem quietly grows. To find the roots of this stagnation, one must look at the specific policy decisions and geographic realities that locked the domestic economy into its current trajectory. The structural vulnerabilities of the American middle class were not manufactured overnight. They are the direct result of legislative choices made over the past 2 decades, combined with infrastructure choices that dates back to the mid-20th century. Consider the foundational shift in municipal zoning laws and housing development that occurred between 2008 and 2018. Following the collapse of the subprime mortgage market in 2008, residential construction fell to historic lows. For a decade, the United States underbuilt housing relative to population growth by an estimated 3.8 million units, according to data from Freddie Mac. When demand surged in 2021, there was no inventory cushion. Local zoning restrictions in major metropolitan areas, particularly single-family zoning mandates, legally prohibited the construction of high-density housing that could have absorbed this influx. Consequently, home prices rose by over 40% between 2020 and 2024, far outpacing the median household income growth of roughly 15% during that same period. The geographic trap deepens when examining the structural dependencies of suburban infrastructure. Approximately 52% of Americans describe their neighborhood as suburban, according to Pew Research Center data. These developments were designed during an era of cheap energy and stable insurance markets. Today, they require massive, continuous capital expenditures to maintain. The physical distance between residential zones, employment hubs, and commercial centers creates an absolute reliance on private vehicular transportation. When the average transaction price for a new vehicle in the United States reached $48,000 in 2024, up from $38,000 in 2019, citizens could not simply substitute public transit. The geographic layout of the suburbs made that choice structurally impossible. Simultaneously, the regulatory framework governing the commercial insurance sector underwent a fundamental breakdown. State insurance commissioners are tasked with approving rate hikes submitted by private carriers. In states like California, Florida, and Louisiana, catastrophic weather events and soaring litigation costs forced insurance companies to reassess their risk models completely. In 2023, State Farm and Allstate ceased writing new homeowners policies in California, citing construction costs that outpaced inflation and an increased risk of wildfires. In Florida, more than a dozen property insurance companies filed for liquidation, or withdrew from the market entirely between 2022 and 2025. The remaining insurers raised premiums by an average of 35% to 50% to maintain solvency. Because state laws and mortgage covenants mandate property insurance, homeowners were trapped in a regulatory vice. They could neither decline the coverage nor find a cheaper alternative. This corporate risk mitigation strategy quickly spread to the consumer credit markets. The Federal Reserve raised the benchmark federal funds rate from near zero in March 2022 to a range of 5.25% to 5.5% by July 2023, keeping it elevated well into 2024 to combat persistent inflation. The explicit goal was to cool the economy by making borrowing expensive. However, the transmission mechanism of this policy hit consumer credit with disproportionate force. The average interest rate on credit cards escalated from 14.5% in 2020 to an unprecedented 22.8% in 2024. For the bottom 60% of households by income, who historically rely on revolving credit to manage cash flow mismatches, this rate hike transformed manageable short-term debt into permanent capital drains. The corporate sector responded to these macroeconomic pressures through systemic cost restructuring, a pattern clearly visible in corporate financial reports from 2022 through 2024. During the initial supply chain disruptions of 2021, publicly traded consumer goods companies realized they could increase profit margins by adjusting packaging volumes rather than retail prices. Financial disclosures from major food conglomerates showed that while input costs stabilized by late 2023, net profit margins remained elevated, often expanding by 200 to 300 basis points. This practice was heavily documented by the Bureau of Labor Statistics, which noted that the price of commodities like sugar, cocoa, and paper pulp increased, but the finished retail price per ounce rose exponentially faster. The labor market underwent an equally rigid transformation. While the National Bureau of Economic Research and the Bureau of Labor Statistics continuously reported historically low unemployment rates, the quality of employment shifted. The creation of full-time, W-2 positions with employer-sponsored healthcare and retirement benefits slowed. In their place, corporate entities expanded their use of independent contractors and third-party logistics firms. This structural shift allowed companies to reduce long-term liabilities. By utilizing the gig economy model, companies transferred the burden of payroll taxes, healthcare costs, and vehicle maintenance directly onto the worker. This brings us to the core financial paradox of the post-2020 era. On paper, corporate balance sheets and federal macroeconomic indicators showed an economy in recovery. Gross domestic product expanded at an annualized rate of 2.5% to 3% in several consecutive quarters. Yet, Federal Reserve data tracking household wealth distributions revealed that the bottom 50% of Americans held just 2.5% of the nation's wealth, while the top 1% held over 30%. The geographic and legislative framework of the modern United States economy had created an environment where the wealth generated by macroeconomic growth was structurally isolated from the wage earners who powered the system. The trap was set over 20 years of deregulation, underbuilding, and infrastructure neglect. By the time the external shock of the pandemic hit, the system had no elasticity left to absorb the blow, forcing ordinary households to navigate a rigid, high-cost environment with diminishing structural support. This macroeconomic divergence has solidified into a direct conflict between institutional balance sheets and household survival strategies. By the first half of 2026, corporate performance and consumer vulnerability reached simultaneous record highs, stripping away the narrative that macroeconomic health translates directly into domestic stability. The clash is no longer theoretical. It is documented across corporate earnings calls, court dockets, and central bank registries. The primary arena of this conflict is the consumer debt sector. According to the Federal Reserve Bank of New York's data released in May 2026, the aggregate credit card balance in the United States reached an unprecedented $1.25 trillion in the first quarter of the year. This represents an increase from $1.18 trillion in the first quarter of 2025. While federal agencies previously classified this debt accumulation as a sign of consumer confidence and robust demand, the underlying metrics reveal structural exhaustion. The transition rate of credit card accounts into serious delinquency, defined as 90 days or more past due, climbed to 13.12% in early 2026. This is the highest level recorded in 15 years, directly surpassing pre-pandemic averages and matching strains last witnessed during the aftermath of the 2008 financial crisis. www.ocrates.com, the escalation of debt servicing costs acts as a direct wealth transfer from working households to financial institutions. The Federal Reserve reported that the average interest rate across all credit card accounts held steady at 21%, while accounts actively carrying a balance faced average rates of 21.52%. For an individual consumer carrying the national average balance of $6,595, these interest rates create an annual financial penalty of over $400 solely for maintaining the debt. This capital does not cycle back into the local economy through consumer spending. Instead, it remains locked within commercial banking reserves, which reported total profits after tax climbing to an annualized rate of $3.95 trillion in the first quarter of 2026. Up from $3.33 trillion in early 2025. W.Rates.com. Michaud 1. This divergence has triggered an explicit clash between state authorities and federal corporate frameworks. In late 2025 and early 2026, a coalition of state attorneys general initiated regulatory inquiries into the pricing mechanisms of major consumer packaged goods firms and corporate grocery chains. The conflict centers on margin expansion. Corporate financial disclosures from the first quarter of 2026 demonstrate that while raw agricultural commodities and global shipping indices returned to their 10-year historical means, retail prices remained fixed at their peak inflation levels. A mid-year corporate outlook report by PricewaterhouseCoopers noted that major food and beverage portfolios are undergoing radical strategic consolidations, with deal values doubling year over year to $120 billion in early 2026. These mega deals are designed to lock in market share and maintain high pricing power, even as federal food assistance programs, contract and consumer affordability pressure intensifies. www.wc.com. A parallel structural bottleneck has developed within the domestic rental market, creating a bitter legal and economic battlefield between institutional landlords and municipal populations. Real estate analytics firms reported that institutional investors, private equity firms, and publicly traded real estate investment trusts purchased up to 30% of available single-family homes in mid-sized metropolitan areas over the previous 24 months. In cities like Phoenix, Atlanta, and Charlotte, this concentration of ownership allowed corporate landlords to implement algorithmic pricing models. Software programs analyze localized vacancy rates to maximize rent yields, often choosing to leave units empty rather than lowering asking prices. This corporate optimization strategy has run directly into an infrastructure and public service crisis. Municipal court systems across the Sun Belt reported record-breaking eviction filings in late 2025 and the first half of 2026. In June 2026, legal aid societies in Texas and Florida documented that eviction dockets were operating at 120% of their typical capacity, driven entirely by rent increases that exceeded local median wage growth. The tension between municipal ordinances attempting to cap administrative fees and corporate lobbies challenging those restrictions in federal courts has reached a standstill. Cities are facing rising homelessness and public service deficits, while institutional housing portfolios report stable, predictable returns for their shareholders. The labor market mirrors this administrative gridlock. Corporate entities have aggressively adopted automated applicant tracking systems to manage the volume of job seekers. A 2026 Human Resources Executive Survey indicated that over 70% of Fortune 500 companies utilize machine learning algorithms to screen initial applications. The widespread deployment of these systems has led to the proliferation of ghost jobs, postings maintained indefinitely to satisfy investor perceptions of corporate growth or to gather labor data without any allocated budget for hiring. The Bureau of Labor Statistics data shows that while the aggregate job openings number remains technically high, The median duration an applicant spends seeking employment in professional services has extended from 9 weeks in 2021 to over 22 weeks in 2026. The current economic reality is defined by this absolute duplication of realities. The executive summary of a major investment bank can correctly state that corporate liquidity is exceptional, asset valuations are robust, and macroeconomic metrics indicate a resilient expansion. Simultaneously, the financial ledger of a median 4-person household correctly demonstrates that real purchasing power has decayed, debt costs are mathematically unsustainable, and the traditional mechanisms of financial advancement are structurally blocked. The conflict is no longer a temporary friction caused by supply chain anomalies or interest rate adjustments. It is an equilibrium state where the financial health of the institutional infrastructure is directly maintained by the prolonged economic suppression of the domestic population.